Okay, for this mock exercise, we're going to take a look at decision making, relevant information for decision making. We're going to use snowboard questions, snowboard question, and we're going to take a look at some of the concepts that we learned from Chapter 3, which is cost, volume, profit analysis. And we're going to take a look at a single constraint in this case. So let's take a look at the question. So this question is the company called Snowbird Snowboards converts regular snowboards by adding outriggers and seats so that people can use wheelchairs, can snowboard. The income statement for the year in which 500 snowboards were produced and sold appears as follows. So this revenue is 500 units of snowboard. Okay, so now we know how much the revenue is, right? So the revenue per unit must be 1,500 divided by 500, which is $300 per unit. Okay, now these are the variable, these are the costs: variable, production, fixed, variable, and fixed. And they made profits of $20,000. The question says, what volume of snowboard must be sold to earn a pre-tax income of 30? So now it's asking us, how many do we need to sell? Well, they sold 500 units, they only made 20,000. So we need to know what that volume is. So the first thing we need to do is we need to determine our cost function. We need to determine that cost function that we learned in the previous mock exercise. And that cost function we're going to need to figure out is the variable and fixed component. So really what we're asking you to do for part A is provide the equation y plus a plus bx. And A stands for fixed cost and B stands for variable rate. Variable cost rate. That's really what we're asking you to do. So, first, we need to categorize our cost into fixed and variable. So the first one is, now this question is quite simple, right? Because they've really simplified it for us by giving us the fixed and variable. So I can see a question that could be a little bit more complex by getting you to think about each of these expenses as whether they're fixed or variable, or perhaps, and we've seen in other mock exercise, they could be mixed. They could be mixed cost. But here, they've given it to us, so it's quite simple actually. So we know that variable production is 60,000 under the variable column. We've got fixed production is 25. We've got variable SG&A, and that's 10,000 on this side, and you've got fixed SG&A, and that's 35. So the total is 60. This one is 70,000. Now, we're going to divide this by 500 boards to give us the variable rate of $140 each. So our cost function is really y equals 60,000 plus 140 times x. That's our cost function. Now we know that the selling price is, we just calculated that, but let me do it back here again. Divided by 500 is $300 per board. So to determine the profit, we know that we know that profit of 30 using CVP equals revenue minus variable cost times X minus 60,000 fixed cost. And we solve for X. X equals 90,000. Sorry, it's not 90,000. It's 562.50. That's the number of units. And that or 563. That's the answer. Sorry, I was calculating for the number of units. Okay? So we need to sell 563. We're only selling 500, so that's why we're not achieving that, the number snowboard. Okay? Now, part B says, snowbird suppliers of snowboard is unable to ship more than 500. So that's the max for the upcoming season. Snowbird has been paying the supplier $85 for each snowboard, so that would have been part of the variable production. Okay? So let me see. It would be 60 divided by 500. So this would be $120 per unit, but 85 of that is the cost of paying the supplier for each snowboard. The cost of snowboards is included in the variable production cost. More expensive snowboards are available for other manufacturers for conversion. If snowbirds managers expect to sell more than 500 in the upcoming season, what is the most they would be willing to pay an outside supplier for each additional snowboard? So let's think about this, right? So we need to know the maximum, and the maximum price they're willing to pay would be the amount that would make them break even. So they wouldn't pay more than what's the profit that they're willing to give up for this additional snowboard, more than the 500 snowboard. They wouldn't pay more than the profits that they would have given up. Because if they paid more for the profits for each of the snowboards, then it would clearly mean that they would be operating at a loss, which is not a good idea. So managers for part B are willing to pay. So right now, they're paying $85. Okay? Now, they would be willing to pay $85 plus the contribution margin loss. And what's the contribution margin lost here? It's going to be the sales price of $300 minus the variable cost of $140. So that's $160. So they are willing to pay basically $160 plus $85 or $245 for each of the snowboard. So by managers are willing to pay $245, which is what they're paying now at $85 plus the contribution margin loss. And that contribution margin loss, if they're going to pay more than that, they're going to start creating losses, and that's not good. Okay? Now part C asked, suppose that Snowbird pays the price you calculated in B and sells additional 200 snowboard. What is the incremental profit of the 200 snowboard? So we know that for part C, the incremental profit per unit so revenue is going to be $300 per unit. Now the variable cost, now fixed cost will remain the same, so that it becomes irrelevant in decision making. The variable cost would be the 245. Actually, the variable cost would be the variable cost would be the 140 plus the contribution margin loss, which is 160. It'd be 300. So if you think about it, they're going to make zero profit on that 200 units. So it's the incremental profit per unit for 200 snowboards. Okay? Thank you.